We're rolling.
Welcome to the House Dudes podcast, where we invite you to follow us on our journey towards financial freedom using the power of real estate. I'm Jack Haas.
And I'm Josh Koth. Here at House Dudes, we believe in a couple key principles. Number one, the best way to retain information is by teaching it to others. And number two, a rising tide lifts all boats. We're not competitors, we're a community. So let's get into some real estate investing.
Well, we have Lane Kawaoka on the line. And Lane, I can't thank you enough for taking the time. We kind of played a little calendar juggling here, but so I appreciate the flexibility too. But I wanted to start things off like we always do with you just kind of giving us a little background on what you do.
Yeah, so I'm kind of used to be a working professional. I used to be an engineer not too long ago, but I started investing in 2009. More of a passive investor. I bought a house to live in and I realized I was never there. And then I started to rent it out. And at that point I became hooked with all this stuff.
Right.
And I just used standard 20% down payments. I went to my engineering job for about 12 years until I finally quit. But, maybe I can kind of talk about building that passive portfolio slowly, but surely. It's not a get rich quick thing is the way I see it.
Yeah, I think a lot of people kind of get into this business thinking it's exactly that, don't they? Especially with the touring training that comes through town.
Right. I mean, my strategy is very simple. I go to my day job, make a lot of money there, and then just pour it into investments, standard 20% down payments, and then I just invest where the numbers make sense. So where the rent to value ratios make sense, and in B and C properties.
Sure.
For the most part.
So you're really where do you live today? Let's start there.
Yes, today I live in Honolulu, Hawaii, which is nowhere near where you would like to invest. I've subscribed to the live where you want, but invest where the numbers make sense.
Sure. So where are you primarily investing today?
Today, it's mostly in the South and Southeast. I mean, that's where the population is generally moving down, to the warmer climates. Maybe it has to do with, people retiring. But I think it's mostly driven by like the blue collar jobs are down there. A lot of the Georgias, the Alabamas, the Texases. If you kind of draw a big smiley face on the United States on the bottom half, that's pretty much where all the growth is. So, sure. And that's also where, we try and find markets where the rent to value ratios are at least 1% or higher on the single family home front, or 1.5% or higher on the commercial front.
Sure. So is there like a formula or something you did to decide on like which cities to target, where to invest, or is it mostly you just stay within that certain geographic area?
Yeah, I mean, I think when you get into the more the commercial side, you really have to key in on certain brokers, right? I mean, in single family homes, 80% of the deals are found off market and 20% are on MLS. But in the commercial world, it's flip-flop. 80% of the deals are controlled by brokers. So it's a very unfair game. Unless you've closed a whole bunch of big apartment deals, you don't really have a shot. I mean, why would a broker give you a chance? It's just be wasting their time. And the 20% of off-market deals out there, which I'm sure you could kind of cold call and get, like you frankly don't really want them, or we wouldn't, because I kind of focus in on non-recourse debt projects. So the deal has to have 90% occupied or more. I don't want to mess with anything 30, 60, even 80% occupied. I want to stabilize property in the get-go.
Sure. So can we just back up there for a second? Can you define like non-recourse debt project?
Yeah. So, like a standard home loan, like, you buy your own primary residence, right? That's an example of a recourse debt, right? When 2008 came along and wiped a lot of people out, what a lot of people didn't realize is, now comes the recourse component. Yeah, they can walk away and foreclose on the property, but the bank's going to come after you for the delta difference. So with a lot of these deals, and this is what ultimately made me go to the multifamily route a few years back, is you could get these non-recourse loans, and I was like, why is it that all these like seemingly affluent investors are getting these type of even better deals in terms of lending,
Mm-hmm.
that if a project goes south, as long as that there's no foul play or embezzlement or lying or cheating, the bank can't come after the general partners or the key principals, the people who have signed on the debt.
Mm-hmm.
So it's a way of kind of minimizing your losses. You just lose your down payment and you
Sure.
kind of wipe your hands clean. And
Okay.
it's huge.
So you started this conversation off saying that you work full time and that too. Like, with the amount of volume you were doing, we probably should clarify that as well. Like how long have you been doing this, and how many rentals do you have today?
Currently I have about like 2,800 units. But it sounds really impressive, but really all the, most of the energy took to get to the first 11 properties in the first, from 2009, I bought my first one, and I bought my 11th one, I think in 2015-ish.
Okay.
So it took a really like 6 years to get from 0 to 11. And that's
Right.
really, what I kind of want to focus on this podcast, because going from 11 to 2,800, I mean, it's going to be a very high level type of impractical advice, I think, for a lot of your listeners. I mean, let's
Sure.
just get the first one and let's get this ball moving.
Right.
Stuff
Right.
works, but without getting your first one, you don't get on the track.
Right. It seems like that's actually what my partner and I were talking about this recently, where it was that, we buy a lot of single family homes directly from sellers. We do the traditional methods where we're sending out postcards and what have you. And it took a few mailings, and it took the ball rolling, and landing that first deal was the hardest one. But when that happened, it seemed to pick up. Things got easier after that first one. Would you say
Right.
that's the case for you as well?
Exactly. And I work with a lot of like more passive investors. So they're always trying to like, look at these turnkey rentals, and they're like, yeah, the numbers don't really quite work. And I'm like, yeah, because you're kind of working with an operator who's really expensive, right?
Hmm.
The numbers aren't going to work because you're overpaying. But in the whole grand scheme of things, just get your first one, just make sure that it's reliable and get moving, and then your deal flow should improve as you move along.
Right. Right. So you said you work full time. This sounds like it could possibly be a full time job as well with 2,800 units. How do you balance that?
Yes, I recently quit earlier this year from the day job just because it was just getting a little overwhelming as it
Sure.
was. But yeah, I mean, I work with partners, right? Like I don't work with property managers. Property managers are, we have property managers for sure, but
Hmm.
those are employees, right? At the end of the day, they're $15, $20 an hour employees. I'm not going to entrust them with a $5 million asset,
Right.
right? So there's an extra layer of asset management in here, and that's another partner of mine and me too, where we look over the asset and we manage those property managers accordingly, and we kind of micromanage them in certain cases. But it's that extra layer of oversight,
Sure.
and what makes it work is we have JV contracts within our PPMs, private placement memorandums, and at the end of the day, people are aligned in terms of their interests. We
Hmm.
make money when our partners make money, so, and when the property performs, so we're all kind of pulling in the right direction.
Sure. So when you say those joint ventures, are those people within that city or community that you're investing in as well, or are they remote too?
Yeah, I mean, ideally, like to have somebody who past the property quite frequently, right?
Right.
Which is obviously idea when I'm looking to invest as a limited partner. That's one of the first things I look at. I definitely don't want to have some guy who is operating a deal living in LA
Right.
running a deal out of Texas. That ain't gonna work for me.
Hmm.
But I can see, a deal in Atlanta, and, the operators coming out in Dallas, as long as he flies there, you know, maybe a few times a month, especially in the
Sure.
beginning, you know,
Okay.
that I can live with, and they have the experience.
So how have you been? You talk to a number of you buy these places through brokerages because that's where 80% of your deals are. How do you build those relationships? Because I understand that that's a big part of this, right? Is building those strong relationship with those brokers so they put you in the loop. Some of those brokers they know their buyers, they know the communities, and that relationship aspect is pretty important.
Yeah, I mean, I'll be honest, Jack, I haven't really cracked that nut. I'm not really good at that because what it requires you to do is you really need to be buddy with these brokers. You got to take them to the basketball games, you got to wine and dine them. And if you can tell, I don't really, like my personality, I don't like to do that. So I partner with someone who likes to do that kind of stuff.
Sure.
And I get myself to a level in terms of limited partnership deals where my resume looks like I've closed a lot of deals, which I have. But frankly, I just partner with people who have the deal flow and I cherry pick from those deals.
Sure. Okay.
Right. And at this stage, it's sort of like a team sport, right? I mean, when you're starting out, you've got to do everything.
Right.
But on the bigger scale, you can sort of specialize in what you're good at.
Okay. No, that makes a lot of sense. And I think that takes a lot of vulnerability because, and people they don't have a tendency of being that honest with themselves on identifying what they're good at and what they need help with, and then seeking out those areas. I mean, I've actually, when I first started out, I had a tendency of wanting to try to do everything. And when you start to try to do everything, you become a master of nothing.
Right. I mean, I talk to at least like 2 or 3 investors every single day. Just like, I don't know anything about them and I just see a lot of profiles. And yeah, what you're describing there is like the not having self-awareness. Mm-hmm. One of the biggest things in determining your net worth. It's always those mom and pop investors that think they can do everything and don't trust anybody. I mean, they're the ones under $1 million net worth, or they're under the curve, right? It's the people who can trust other people, realize what they're not good at, find other people who can do it for them, and accept the fact that they're not the best at everything. Those are the people that, numbers don't lie. Their net worth is like 2-3 times the other people, and they got more friends, and they just seem to live a happier life to me.
Right. So, you said finding these partnerships and you did bring up the property management at one point. Can you talk a little bit about how to manage these properties remotely? I mean, you're in Hawaii, you got most of your properties in the southern continental US. And how do you, I mean, we probably could spend most of the podcast just talking about that. I mean, how do you find the proper property managers? How do you build that relationship? We one of our adages, you trust but verify, because nobody's going to care about these places as much as you do. How do you go about that whole process of dealing with and finding these property managers?
Yeah, I mean, I'll start off with like the basics. I mean, like when I was doing single family homes remotely, when I was living in Seattle, managing these properties in Birmingham, Atlanta, Indianapolis, just on my own, without any partners. A lot of it is just keeping people accountable. I mean, I think that's where a lot of, folks that are working professionals, like, myself as an engineer, I was a project manager, construction manager, a lot of times you don't see your boss, nor do you see your employees all the time. So what do? You keep them accountable via phone, email, maybe even text. You set forth expectations and you hold people accountable. And you don't micromanage them, but you keep a short leash on them. Right. And this one example is like one tip. I always like get a plan for my property manager, right? All right, cool. So somebody moved out, they screwed this up, we got to fix that. All right, what's your plan? Tell me what your plan is. Oh, you're going to fix it up. You're going to call this person. You're going to get this bid. You're probably going to have it fixed up in a week. So I'm going to shoot myself an email in a week, reminding myself to follow up with my property manager. And after a while, most people don't do that, right? And as you don't want to be the squeaky, annoying wheel as that asset manager or that owner, but you want to gain a reputation of like, yeah, from the property manager's perspective, this owner, they're on their stuff. I better do it because they're going to call me on it when I don't perform. So, that's really what it comes down to. Just being organized and keeping people accountable.
Sure. Are there any tools or anything that you recommend that people use to stay on top of that?
Yeah, I mean, you can put the stuff on your Google Calendar, big Google guy, but that might get a little cluttered, right?
Right.
You have all these reminders. I like to use followupthen.com. You can send yourself an email, like, if you told me, hey, I'm going to mail you a shirt tomorrow, right? Well, I'm going to go send myself an email 3 days at followupthen.com, and in 3 days, it'll be an automatic email coming back with a reminder for myself to trigger something. It's kind of like a virtual tickler note.
Sure.
I like to use that a lot.
Okay, great. So, I hate to jump into this because I know it might be a little bit early, but when we're talking about a lot of distance investing, I understand you have like 3 rules of investing when it comes to deciding some properties. So can you go through some of that?
Yeah, I mean, I think this is kind of speaking more to people who are on the fence with just investing in an alternative asset class, which, by the way, I don't know what is more real than real estate. That we're taught, it's all these mutual funds and stocks that are all fake paper assets.
Right.
And so for those people who are still on the fence, like, here are my main rules of investing. It's number 1, is it a real asset? Is it tangible? Is it a real thing? Number 2, is it leverageable? I mean, real estate's one of those things where you get these sort of government subsidized loans, and when you get to the bigger stuff, you get this non-recourse debt. I mean, the government is almost begging you to buy this stuff. And then the third is, does it cash flow? Does it produce income today? Right? A lot of these stocks or mutual funds, they don't produce income. Right?
Sure.
You can't eat that. I want to produce enough little mini pensions so that I can retire in 12 years from working my day job. Things like gold, right? Like, people invest in gold, but in my opinion, unless you're over $2 million net worth, where you can just sit on your money and make 3%, that's not a good, valuable way of building equity. Yeah, it's a hard asset, but you can't eat. It doesn't produce income, and it's hard to leverage that stuff.
Sure. So, you've brought that up a couple times now regarding the return on that investment and the tangible net worth, or the tangible asset. Is one of the things that we get questions on quite often, especially at our real estate meetups, is pro formas. So when you're reviewing these properties, especially from a distance, and I know you're trying to find maybe somebody a little more local to partner with, we almost, it may be part of this part of the world, but most times than not, pro formas seem to be as much fiction as they are fact. How do you vet some of that out? How do you make sense of that? We always ask for actuals, of course, but how do you collect all this information and make sense of it?
Yeah, no, you're exactly right. I mean, pro forma means like toilet paper in French, right? So, I mean, I'm sure you guys talk about like single family homes a lot. I mean, for that, I always just run it myself. And there's an analyzer on my website. I think you go to simplepassivecashflow.com/analyzer, and I have this free analyzer that has all the footnotes on, what you should use for CapEx, vacancy, etc.
Sure.
But, I'll speak to maybe like the multifamily syndication stuff out there. Because that's what I kind of keyed on. People send me, pitch decks all the time, but unless I don't really go into a deal unless it's cash flowing day one. So I want to look at the P&Ls, the profit and loss statements, and the rent rolls, and I want to do my own comps, right? Like, it's great that the pro forma, like, you think that it's going to rent for $750 a month. Like, all right, well, that helps just speed my due diligence up. I'm going to go look it up myself. Craigslist, Rent-A-Meter, all these different tools out there are at my disposal. And, what I like about multifamily is that the data is a lot there that you can really, it's not like single family homes. It's all over the place, right? There are, each home is special. Multifamily, it's a commodity. It's a commodity product. You can get it right down to the penny on rent per square foot. So to do this analysis is a very easy, and especially when you get 100, 200 unit building, you know, your averages, your law of averages is going to get a lot more narrow, and you're going to get a lot higher confidence interval. But you know, some things that I check, just the spot check, are like what is assumed reversion cap rates, what is assumed rent increases per year. You know, I don't want to see anything higher than 2.5%, 3% a year. That ain't gonna happen. You know, that's wishful thinking. Sure. And I want to see, you know, full occupancy no higher than 92% a year. You know, anything higher than that's wishful thinking again. So I want to make sure the assumptions are right, so that the pro forma is, you know, a little bit more realistic.
Sure. Those are some good points to take a look at. Like, is there anything else outside of that list? You know, you talked about vacancy rate, but that would be red flags when you're looking at a pro forma?
I mean, the reversion cap rate is probably the biggest thing of them all. You know, so what the reversion cap rate is, it's a little cell on the spreadsheet that says, all right, when we think we're going to sell in 5 years, we think it's going to be this. And quite honestly, we don't know what it's going to be in 5 years, right? So what are we going to do? We're going to assume the worst. We're going to assume that we're selling it in a weaker market. So what I'm going to do is say the current prevailing market cap for a Class C building is 6%. Well, I'm going to assume a higher reversion cap rate. And that sounds a little counterintuitive, but you know, if you can understand how to derive the value of a property via the NOI divided by the cap rate, you know, it kind of makes sense. Sure. So we would assume probably about a 6.75, 7% reversion cap rate, a full point higher than the prevailing cap rate, just to make sure. Okay. Right? Like, and I would run my numbers that way. But if you use, say, 0.5% higher, you kind of cheaped out on being conservative there. That could be the difference between 100% return in 5-year deal and a 70% return in 5-year deal. So a lot of times, you know, investors will say, well, it didn't quite meet my number. And I'm like, all right, well, what do you want? You know, I can change this number, that number. What do you want? You know, like, so as a limited partner, as when you're going through performance, you need to it's not too hard. Like once you understand what to look for, but you need to understand like what the assumptions are and make sure that the number at the bottom of the page better better be in your range, but you got to make sure that you're coming up with using the right assumptions.
Sure. So, you know, I've always been curious about this. You know, you've had some single family rentals, and now it sounds like most of your properties are multifamilies. With both of those backgrounds, is it almost as much work to get a multifamily property as a single family property? You know, I'm talking about the actual workload.
Yeah, I mean, I think from you know, you put the pros and cons. The larger mobile home parks, multifamily syndication deals, it's a no-brainer. They by far win out. But here's the unfortunate thing: unless you're at a certain net worth, like $500,000 or more, you can't play in that game. You have to play with the smaller stuff, and you know, you have to trade sweat equity for time to get your net worth up there. And I see it too often. Some, you know, guys under $100,000 net worth, they think that they can do apartments, and I'm like, all right, well, yeah, you can do it, but it's going to be a 99% failure rate. Right. You know, remember what I did. I mean, I started in 2009 buying single family homes, and I got up to 11. It took me 6-7 years to get up to that point. But at the time, my net worth grew from 0, and it got me to that ground where I could now go after it a little bit.
Sure.
So it's all part of a progression of building your wealth.
So, you know, that might be a misconception too, then, because a lot of people who take the real estate pill, they want to jump all in, and they like you said, there was like a 90% failure rate if you try to jump right into
I would
multifamily?
probably say it's 99. I mean, yeah, you see success stories out there, right? But it's just a self-selecting crowd. You
Mm-hmm.
don't see all the people that crash and burn that would have been successful if they would have just started single family homes and done it
Sure,
the slow way, the slow and sure way. But
sure.
I get it. Everybody wants to sell courses these days. So
Yeah, that's a big
you gotta
part
sell
of
the
the
dream,
business, isn't
right?
it? Yeah,
Yeah.
yeah.
Yeah. I mean, I do deals and they're risky. Make no mistake about it. I could just sell some courses and make easy money all day long. But
Yeah, it is kind of a curiosity in this industry how many people have training and material for sale.
yeah, I mean, when you're on the higher part of the market cycle, like where we are now, and it makes more sense to do education. You take
Mhm.
yourself out of the market cycle. Whether the market goes up or down, there's always a sucker to buy your program.
Yeah. So, how do you advise people to get started? I know I've even had people, and I think I saw it on your bio sheet talking about rescuing your 401k. That I suppose that might be part of your strategy. But how do people get that initial 20% to get the ball rolling?
Yeah, I mean, I talk about like real estate investing on my podcast more for passive investors. You need money to invest, at least 20, 30 grand to buy a turnkey rental for, put that money down on $100,000 house.
Hmm.
If you need money, you need money to invest. If you don't have money, you got a money problem. And I don't fix those problems. I don't do any
Hmm.
creative financing. So for me, it was just go back to my day job and bust my butt there,
Sure.
right? I mean, you can sell drugs, but that's illegal. So you need to get yourself up to a level where you can start buying properties. And it's going to be very slow in the beginning, but that'll increase your monthly cash flow. That'll help you buy more properties.
Hmm. I've run into a few people who they stop trying to do any kind of distance investing because it's harder to build a financial relationship to you bring in the 20%, and because they're not local to the area or something, they find that as a hurdle they can't get over. Like, how do you
Yeah.
build that type of distance relationship with a bank?
Yeah. I mean, well, you're going after Fannie Mae, Freddie Mac mortgage. You don't need to go into a particular bank. I mean, if people want a referral, they can always just, contact me through my website. But
Mm-hmm.
that's not a problem. I mean, that's why I don't like the whole burst strategy people talk about. I mean, for higher net worth individuals, that's kind of a waste of time and it's just too much risk.
Mm-hmm.
For guys making over 100 grand a year at their day job, their time is too valuable to do that stuff. I urge those guys to just buy turnkey rentals, buy them already ready to go. Mortgage the whole thing off the bat. Don't play games.
Right. No, that makes a lot of
Right?
sense.
I mean, the burst strategy makes sense in theory, but it's a single point of failure. You have this guy fixing a house that you're wiring all this money to. At some point, especially with the quality of people you're working with, day to day, paycheck to paycheck people, they're gonna fall on tough times and they're gonna screw you first.
Mm-hmm.
And now you're relying on this bank to like not pull the switch and bait on you. I had a student the other day. He said, "Yeah, this bank said now they're only going to lend to him at 60 LTV." I'm like, "Yeah, I told you not to do that, man. I told you just to go buy turnkey from the get go. This is what
Mm-hmm.
happens when you get tricky."
Hmm. Yeah. Huh. So tell us a little bit about your business. It sounds like you turnkey quite a bit, or you do a lot of passive income. How does that all work?
Yeah, I mean, I help kind of my more higher net worth investors kind of get on the path to financial freedom. For the guys under $500,000 net worth, those guys should generally start off with turnkey rentals, right?
Mhm.
They've got, they make $60,000 or more at their day job, and they're able to, they have pretty good control over their finances, right? They may
Right.
be able to only save $20,000 a year, but they can probably get on a good schedule of buying a rental property once or every couple years. And that's
Mhm.
great, right? In 5 years, they might amass a 5 or 10 portfolio and be
Mhm.
definitely on the track. But for the guys who are $500,000 or more, yeah, you can still buy some single family homes as you see them, but for those guys, it makes more sense to jump into the world of multifamily and syndications and private placements. So you can diversify over many deals with different partners, different asset classes, and it's just a lot cleaner.
Sure.
Right.
And then you kind of, based on your experience as a project manager, you have the skills to pull all of the pieces together and make it happen.
Right. And, like just looking back on like my experience, like going from 0 properties to 11 at the snail's pace, like I really didn't start to explode my portfolio until I started to join masterminds and found other engineers, doctors, lawyers, pharmacists that kind of was like a few years ahead of me, definitely like my pedigree as a higher paid professional. And, I got around those type of ideas because what the wealthy are doing is completely different than what everybody else is doing in the world. And it's very counterintuitive.
That's really interesting you bring that up. Like the concept of a mastermind, and it's one of those things everybody hears that you're part of the 5 people you hang out with, but I don't think people really take that to heart. And it's how important it is to be around people who are in better situations than you. You typically will evolve towards them. Like how important, how big of that is part of what you do?
Yeah, I mean, I think the accountability is a big piece of it. Some people just need to be, whether they believe it or not. Again, it comes in the whole self-awareness thing, right? I mean, I think most people need that accountability, myself included. But, one little nuance I've been seeing is, when you're 0 to $500,000 net worth, yeah, you need a network, but it's not entirely, I think you got to get there yourself. You have to put in the hard work, determination, and you got to figure it out on your own. But when you get above $500,000, your network is your net worth whole saying is so much more true. I mean, the whole reason why I took that next step was because I started to create real relationships with other high net worth individuals. And that was where I found all my deal flow. That was where I was able to cross-reference who to work with, what deals to go into, how to underwrite deals. And without those relationships, I mean, that's really my currency. It's all social capital these days.
Yeah, it's just really interesting that aspect, how important it is to have that sort of experience diversification. A lot of the masterminds and the training and networking that we've seen kind of restricts people to fellow real estate investors, which is also important. But some of the best experiences I've had have been in masterminds and meetings with successful business owners with a variety of a diverse background. It really it gives you a different perspective.
Right. And then where it's less like non-competitive, right? Because sometimes if someone's in your backyard or doing the same exact thing you're doing, it can be a little tough. But exactly to your point there.
So the mastermind you're a part of, is it virtual? Is it like in person? How does that work?
Well, that's the other thing. I've joined multiple of them, right?
Sure.
So I mean, I think that's also another perspective too, is you need to join a myriad of them. But maybe I'll kind of just caveat things. Like you need to get to that certain platform. You got to get yourself to $250,000, $500,000 net worth before you even start thinking about this stuff. Because I call it this, like most people get this wrong. Like I call it like how do you grow your business with networking and growing? Like you need to grow a little bit, then network, and grow a little bit, and then network. You can't just do both. Right. You have to level up to a certain level and take your network up to that level.
Sure.
Then you can bust your butt and get there again with your network. I think too often, here's an obvious mistake, is like the guy who just runs around all day at the RIA passing out cards and he hasn't done jack.
Yeah. No, I know. We've had people who come to the real estate meetups and they keep talking about wanting to do this or that or find their first deal, and it's been the same song for over a year. you
Yeah.
know.
I mean, me personally, I stopped going to local RIAs maybe like a few years ago because they're not the place for high net worth investors.
Mhm.
They a lot of times, I mean, a local RIA is a great way to get motivated if you're started, but quite frankly, most people in the crowd have less than $50,000 net worth.
Mhm.
I mean, that's why they go there, right? Here, real estate's a great way to get started.
Right. No, yeah, that makes some sense. You know, like you mentioned, it is a great place to get started. You don't want to discourage people from attending those. In fact, we host our local one. And
Right.
we'd like to believe that we add a lot of value, um, but yeah, it's kind of interesting. Also, on the flip side, as somebody who hosts these events, is it's kind of a revolving door. You know, people come in and out, and it's not a very consistent crew.
Right. Right. And that's the thing, right? Like if you do go, just go in with your eyes wide open, knowing that most of these guys come in out of that revolving door. But I think if you just commit to going 3 times, you'll notice who are the regulars and just spend your time with those people, adding value to them.
So, can you give us like you were talking about like some of the bigger mistakes? Are there any other big mistakes that like early investors might make that they should avoid?
I mean, I haven't made much mistakes starting out because, I'm a passive investor. I invest off cash flow from the get-go. But I didn't make my first mistake probably in like 6, 7 years into it, where I invested. I was trying out my first limited partner deal, and I just turned out to invest with a shyster that eventually ran the LLC into the ground, and I pretty much lost I think I lost like 40 grand.
Mm.
But it was kind of funny, like 6 months after I went into the deal, my network was growing, and like I said, building relationships with like more high net worth passive investors, and who told me, yeah, that guy's a shyster. And I'm like, all right, well, I hope he doesn't do this again. But sure enough, a year or two later, he did. He kind of came clean and said, yeah, we all lost our money. I didn't pursue legal action because I'm just not really into that. And then that drains a lot of your life energy to go and do other things, in my opinion. But just goes to show, right? Like, build up your network. If I would have had my network to where it was just a year later, I wouldn't have made that mistake.
Yeah, yeah. No, that makes sense.
And the lesson learned is don't work with anybody you don't know, like, or trust. Right? People shoot me emails all the time saying, hey, we need money for this, we need money for that. Like, dude, it ain't gonna happen. If we haven't met in person, done. We're not working with each other.
Sure.
And what I need is 3 people to vouch for you, and somebody I know that I already have a pre-existing relationship and a good personal relationship who knows who you are. If you're just some random person, I mean, that's where all the shysters come from. They're all just random people that seemingly come up from nowhere. I mean, there's a lot of guys on podcasts. I had a guy on my podcast where he just turned out to be a shyster that I had to remove. Right? It's hard.
Mm-hmm.
You don't know in this business.
Right. Yeah, that is a really good tip. I like that regarding the referrals.
Right.
I think when it comes to turnkey, especially, people kind of just take their word for it.
Yeah, I mean, like whenever somebody will bring in my deal or something to me, and I always ask them, like, you know what I'm going to ask, right? Who is this person? How do you know? Do you know him personally, or did you just hear it from a referral?
Sure.
Right. None of this like proxy referral stuff.
Mm-hmm.
I wanted somebody to know this person. And at this point, I'm in a stage where I have more than enough people that I already know and I trust. So for me, there's so many good people too doing good deals that everybody knows, that why is it worth taking a chance at some rando?
Right. Yeah, that's a really good point. I mean, it's probably, that's gold when it comes to tips, when it comes to working and building that network, especially remotely.
Right.
Trust but verify. Again.
Right.
So, Well, I think we've been talking for, I bet you like 40 minutes. I told you it was going to be like a half an hour. But I always ask, are there any questions that you wish I would have asked you?
No, that's it. Maybe if you guys have any more questions, we can do another one of these in the future.
Yeah, that'd be awesome. But where can people find you? And then I'll also make sure that all your links are in the show notes.
Yeah, so my podcast is Simple Passive Cash Flow, found on iTunes, Google Play, all those. And then
Sure.
my website is simplepassivecashflow.com. A whole bunch of articles on there. And I think maybe like, if you guys are getting started, I would check out the first 20 of my podcasts. They're all about, you know, finding turnkey rentals and getting started with that. That would be, for folks getting started, I would recommend that. And yeah, if, once you listen to those first 20 podcasts and you're willing to figure out how to listen to well, you guys already listened to Jack's podcast, so you guys have figured that out. But if you can listen to 20 podcasts, look, I'll spend a 15-minute call with you.
Yeah, that's awesome.
Yeah.
That's a good tip. We had somebody recently who shadowed us for a day, and and it was their offer versus us, but he said he was going to hopefully pay us back with showing us some success. And I like that he mentally made that commitment.
Yeah. And I think you get this a lot too, right? Like guys, they just, they seem to write you a nice introduction email, and they seem very motivated, but very few guys actually put in the effort in like as the weeks progress. And for you to help somebody, it's very, you kind of lose distrust. And you're like, are you just another guy who's just going to give up? And then, the worst one is like, hey, Jack, tell me how I can add value to you. It's like,
yeah,
no, like Jack's too busy. He doesn't have time for thinking of things for you to do. You go out, figure out what Jack needs, and you go out and do it for them without any quid pro quo attached to it.
Yeah. No, you're right. We do get those emails, and I appreciate them trying, but you're right. I typically don't respond to some emails. Some of the best ones though, and it's something really simple. We get people asking us for coffee or lunch or something all the time, and I'm not saying I'm expecting a free lunch, but if you're inviting or asking somebody for some advice or wanting them to meet for coffee, you can at least buy them the coffee.
Yeah.
But I really appreciate your time, Lane. This was a great conversation, and I hope we can do it again.
Yeah. I call those guys assholes. Ass.
Yeah, it's happened more than once, and I just find it a little social oddity. I would never have done that.
Before I would help those guys out, but now I realize like those guys never get anywhere with that kind of strategy.
Yeah.
Yeah. I would read the book Givers and Takers.
Oh, sure.
Yeah.
Yeah. In fact, I've been revisiting Go Giver.
Oh yeah. That's very similar too, right? Same premise.
Yeah. I really, really like that book. And, but yeah, it's, that concept is something that I can't recommend enough.
Yeah.
In fact, I was thinking that maybe that's what we need to start to do is that before we meet with somebody, they have to read a couple books or something. Know that, try to set that expectation.
Yeah. I mean, my like strategy is like, look, I'll be the first one to give, and I just give freely. But what's interesting is like the go-givers, right? The truly abundance mindset people that you want to have in your network, you'll keep them around, or they'll come back, right. Or the assholes will just disappear, which is cool. They leave me alone.
I'm going to steal that term. I love that, assholes.
Yeah. You got to give me credit 3 times first, and then it's yours.
Yep, I'll definitely do that.
Yeah.
So,
okay.
Well, thanks again, Lane, and I hope to have you on again soon.
Okay. Take it easy, Jack.
Yep.
Bye.
Bye. We've put a lot of effort into providing useful content, and if you found value in the show and have any interest in supporting us with a small donation, head over to patreon.com/housedudes.
And if you have any thoughts or questions, shoot us an email at info@housedudes.com. You can also find us on Facebook, Instagram, and Twitter at housedudes. And if you like what you're hearing, head over to iTunes, subscribe, rate, and review the podcast. It really helps other investors out there find the show.
And remember, massive positive impact requires
massive positive action. We'll see you next time. This episode was brought to you by housedudes.com. Do you live in a good cash flowing market? If so, turnkey isn't the best choice for you. You should buy in your market. If you don't live in a great market for investors, where can you find profitable cash flowing properties? We love the Midwest, where prices are reasonable and the people are great. We personally invest here and have lived in the area all of our lives. So how does turnkey work? We find the property, we rehab the property, and we find you a tenant and place you under the care of our local property manager, who we trust with all our own investment properties. I'm sure you have questions about how the process works and what to do next. If that's the case, fill out the contact form on housedudes.com, and we'll reach out to see if you are a good fit for our business. We have a limited supply of properties every month, so we can only sell to a select few qualified buyers. We'll see you on housedudes.com.
I don't like to tell a man what to do with his money, but if you ain't investing in property, then you're dumber than a dummy.
I'm not dumb. I'm smart.
Well, buy property. That's my advice.